will become more comfortable, because passing through your hand this data set, specifically capital budgeting data set, with 3 different examples will make you sufficiently uh, learned or sufficiently equipped that you can apply this on your own data set. And that data set you are going to take from your own company, right? Therefore, whatever values you need to pick, be careful about them. All that information is available on these financial statements. Only you have to extract that, and only you have to make some kind of adjustment. If you are going to face any kind of trouble, you may get my help. Otherwise, by yourself you can do that. Just like uh, fixed in cost or fixed investment or fixed equipment cost is your initial investment outlay, and then if there is no depreciation or a salvage value mentioned, and usually it is not usually mentioned, so you can assume any salvage value. Let's suppose your equipment cost is 25 million rupees, and then you are taking the salvage value of 5 million rupees or 10 million rupees. So in this way, right, you can take that, and if you have the values for 20 years, then depreciation is going to happen over the 20 years. So in this way, you are going to take this thing, and straight line depreciation at this point of time is sufficient. Later you can change it. And secondly, tax rate, whatever is there, you can apply that. Interest rate, whatever is there, you can apply that, because that is mentioned there. If it is not given, then definitely what you can do, you can take the any assumed value from the existing market rate of interest. Just like nowadays, if rate of interest is 9.5% or 10%, you can assume 10%, right, for that purpose. Thing is that these values are, or these input values are variable, changeable. So there is no problem if you are going to assume any value in the beginning, and then you are going to make it change, make it different afterward, and try to find out the impact of that. So basically, this is the part of your learning. Clear? So I'm just going to brief you about this risk and capital budgeting process, the connectivity between two, very simply, without any further application of this software, right? Because already you have done whatsoever is done. I don't want to put more burden, because definitely whenever we are interacting in the class in person, you can resolve your issues quickly, whatsoever you are doing on the computer, and I can observe you. But through this remote system, it's really difficult sometimes, because whenever you are observing that, you are not doing that simultaneously. So in that case, you may face more problems, and it is not easy to resolve them quickly. Therefore, I'm just going to give you the brief idea about this in the beginning. Well, let's suppose 20-25 minutes, and then we are going to have some discussion about whatsoever we have done previously, right? And then you can resolve any kind of problem in your mind regarding all these topics, whatever we have discussed. So first of all, first thing is that whenever we are talking about risk, then actually we are talking about any kind of damage you may face or company may face due to any kind of variation in any kind of financial input. And financial input means any kind of financial value. It may be interest rate, it may be equipment cost, it may be depreciation. Depreciation is usually given because it depends upon the nature of the a fixed asset. It may be interest rate, it may be inflation, which may affect your revenue return. It may be sales, because sometimes you are losing your customers. So multiple things are going to affect your business. So you have to be actually prepared for that. You cannot control the external factors, but at least you can make internal system more stronger to face any kind of disaster coming outside, right? So any external impact need to be absorbed by the system. If your system is working well, effectively, and you already have prepared for this, then you can manage it. Just like you know that if you are prepared for some rainy season, then you can manage it. But if it comes unexpectedly, then you are in trouble, right? So that is the situation you can understand. Okay, we are going to just brief you that just like cash flows can be expected to vary above, this is very simple. Future operating cost may be higher or lower than anticipated. So these kind of changes maybe happen. How to measure risk in terms of probability of simple situation and scenario for more complex situation, to define the upper and lower bounds of the range of possible outcomes as well as the most probable outcome. So this is the most important thing you have to understand. Actually, we are going to apply the probability and try to find out the possible variation. Just like if interest rate is going to change from this level to this level, decreasing interest rate is not going to hurt you, increasing interest rate is going to hurt you. So let's suppose currently 10% interest rate exists. If it is going to rise to 20%, how much impact it will be on your project? Can you afford still your project to be financed through loan, or whatever loan already you have taken can be serviced or not? So all these kind of decisions you should be prepared for all these kind of situations, right? And then you can accordingly take your decision. Actually, this Monte Carlo simulation cannot be applied now because time short. Otherwise, definitely I have the intentions to do that. Anyhow, in capital budgeting, the least certain are usually the future sales. So actually, this future sale is not clear. Mean to say, you don't know what would be this future sale, but what is clear in your mind that it should increase, or it should be it should remain stable, sustainable, right? So these directly affect year and benefit and calculation of investment profitability. So because what is the purpose of selling your product is just to generate maximum profit. So create a downside risk chart to obtain effectiveness. So this downside risk chart need to be established. So that is quite helpful for you. So you can use that to make your understanding clear about this, how things are going to change. So just like this is the diagram. This is what accumulated distribution of a probability distribution, accumulated probability distribution. Just like you are going to have a probability distribution inverted U shape, right? Or this bell shape, inverted bell shape. But if you are going to accumulate, if you are going to take sum of all these values in the next and next value, so it will come to this accumulative chart, right? So actually this chart shows the level of probability and at the end 100% probability, because everything is accumulated and sum up. So how your net present value is going to vary over this probability? What is the probability that you may have $1 lakh income or sales revenue or net present value? What is the probability you may have 2 lakh? Sorry. Do you have any problem? Hello.
No, sir.
Okay. Now this 2 lakh, it may have just like 50% probability that up to 2 lakh net present value you may have, or 90% probability that 3 lakh dollar you may have as a net present value. So actually this probability distribution is helping to identify through this probability that how much risk exists in this case, right? Because how probability is connected with the risk element, you know that whenever we are going to apply the chances, how much likelihood of happening something, then it is the likelihood, it is not a certain situation. And situation which is going to be certain or ensured or exist in reality, or you say matured, it comes later, because you are talking in future about future, and future comes afterward, right? Then you try to observe that whatever estimation you are making, whatever forecasting you are doing, whatever expectation you are having for the future, are they going to be same, or they are going to be deviated? More the deviation, more problematic situation. Let's suppose you plan to sell 5,000 units of your product in next month. After 1 month, you calculate how much you sold. If you sold only 2,000, 3,000 is surplus, so you have to sell at loss, throw it into the market to liquidate your cash. So this is great problematic situation, because your estimation 5,000 and the actual 2,000 has huge difference, 60% difference. But on the other side, if you are planning 5,000, selling 5,000, and you start producing 5,000 units, and you successfully sell 4,800, 4,500 units, the margin of error is quite low, and that is manageable. It is not going to hurt your profit. It is not going to hurt your whatever other things are connected with this profit, right? So the point is that estimation, your expectation, your future plans should be more accurate, mean to say they should be very close to the reality. And it is only possible if you incorporate all possible information more effectively. If you have some information but major chunk of information is out, you are going to make your decision and you may be wrong. If you are trying to capture maximum information and place it into your model and to your design, to your structure to make some decision, then you can have better decision, you can have better estimations, right? Therefore it is usually happen that we try to apply this probability with maximum possible information, so that we we must ensure that whatever project, because everything is being done in corporate sector in form of project. So just like selling next 5 unit 1,000 unit is a project, so they are going to follow it just like that. So how much whatever they are going to apply information to follow this project should be completely available, mean you should use available information and then you should need to apply this probability. Okay, just like this part of the diagram you already know, because you have done work on this part of the diagram, right? You have calculated your, only thing is that this part I didn't mention separately, but I think last time in last class I have mentioned no. I think no, not for you and not for other class. So if you incorporate these values, it's not difficult to be done. Very simple. Actually, it is showing selling prices at the end of the whenever you are selling your equipment after for salvage value, recovering salvage value, right? Then this part can be done. So the values I mentioned how you can do that in the slide. It's not going to be more complicated. So if you are not going to do that, without it even you can do all these things, right? So there's no problem with reference to this component. So don't worry about this component. If you can do it, that's great. If you are unable to do, no issue. Still you can get these things. So these are showing your annual revenues, so NPV, IRR, MIRR, and a year of break-even point. So what you are going to do actually, you are going to change your values of your annual, year, and benefit, right? So annual, year, and benefits are whatever you, for every year you are going to put a new value for this, and you are getting a new value for NPV and IRR, MIR in year, and then you have to actually apply this probability, and this probability it can be calculated by applying this normal distribution, right? This normal distribution function is already given, so I'm not going to use this normal probability normal distribution function, right? Because I'm not expecting from you that you need to calculate this uh, this last column. Still you can do that, but still because you have to have all these values beforehand. So what is the best strategy? Just you need to know how to explain this behavior. So if just like I'm going to ask by showing this diagram that, okay, try to explain what is the purpose of this diagram and how this diagram shows the risk related to net present value, then you are capable to explain that. That is sufficient at this point of time. Okay, second thing is that you, whatever investors are doing, whatever businessmen or corporate sector is doing, they try to reduce the risk because they cannot minimize or remove or eliminate the risk. Risk is cannot be eliminated. It can be minimized. It can be reduced. Number one, how it can be reduced by incorporating best maximum possible information in your estimation procedure, in your modeling, and so on. Secondly, you are already done sensitivity analysis. Just like previously we have done sensitivity analysis, and I'm just going to show you this part of this whatever you have done in capital budgeting process. So you know this is the sensitivity analysis and you have done this part, right? So actually the purpose of doing that is to evaluate whenever situation is going to vary, how things are going to be affect your business. So how things are, if all these possibilities are affordable to you, then you should not be worried because now risk is manageable, right? But if some of the situation out of them are dangerous or causing the problem that you may go for close down or you may face some losses, then that is the actually situation. These are that kind of situation in which you have to worry. So actually you try to minimize or eliminate those possibility. So what you can do, let's suppose, if in this case, let's suppose, generally it is not happening, but let's suppose if I'm going to do that, in which case it can be happened. Quickly we can do that. Let's suppose if your discount rate reaches to 0.45, right? And let's see, is there what kind of impact it's going. So it become negative. 45 is quite high. Maybe 40 is sufficient. Still it is negative, right? So 40% discount rate if increases, then what happens? You will find that your net present value become negative, right, in the last year. So this project is never and is not going to recover its cost for all 5 years. Therefore, this is not a good project. It's totally failure, right? In that kind of situation, this means that this is the most sensitive area. If discount rate is growing more and more, or you are going to finance your project based on these loans, then you are in trouble. So you have to avoid that trouble. Actually, the maximum you try to actually move back as much as possible. These positive values should come as early as possible. Basically, every human being has the instinct that whatever investment I'm going to do today, it should be recovered tomorrow, so quickly, over the night. So that is the basically our instinct or our desire, our behavior, because it's quite natural. We want to get our investment, we want to get our money as much as early possible, recover that money as much as early or as much as quickly possible, right? So the point is that, but in reality on ground, it's not possible. You have to wait. In some projects you have to wait for very long. In some businesses may wait a bit smaller. Just like you open a general store, you invested, you spend money, and within a week you establish your setup, and next day you start selling the product, and let's suppose within few months you can recover your cost, because all these items are usually used multiple times, but lot number of customers. So many customers are coming and they are buying your product. And let's go, if you are quite lucky to offer or establish that store in that area which is highly populated, but there's no alternative option available to the people nearby, right? Therefore, what will happen? Everyone is rushing to your store, and so you can quickly recover your original investment very soon. But on the other side, if you are establishing a big factory and then you are going to apply different technological equipments, and then you are going to start your selling, and then you want to recover your funds, then it will take quite a long time. Durables, specifically auto or furniture or big things, they need more time to be sold, so they are going to be liquidated slowly. So ultimately, you have to actually decide what kind of project, what kind of business you are going to do, and how you are going to recover your funds. Okay, specifically in case of this financial situation, you know that this discount rate is very much important, because many times you have to take the loan from the bank. On the other side, very interesting thing is that, let's suppose how you are comparing that. You have two options. Either you need to finance your project or business already going on, but need more money to expand or diversify. You can take loan from the bank on which you have to pay the interest. So variation in interest is going to create problem, headache for you. Second option, let's suppose, set aside this option. Arrange the financer, the investors, selling the shares and getting the funds from the investors or the owners, right? These shareholders. Now, what they are demanding the dividend, whatever share in profit. So how much more share in profit you are going to offer them? That is being, they are attracting more shareholders, more people to buy your shares, number one. Second, the value of your firm, if it is growing, if rising, your brand name is going to be established more stronger and stronger. Definitely your share is in high demand, so their value will rise. You are growing, it will cause impact on your share prices. So the point is that selling share is very easy way to finance your business, risk free to an extent. because they invested, these investors or businessmen who are buying your shares, they are becoming an owner of your business, are actually contributing in terms of, or sharing in terms of profit and losses. If you are bearing losses, they are sharing losses with you. If you are bearing profit, they are sharing, you have to share profit with them. Right? So that kind of situation. But on the other side, in case of loan, you have to pay the interest and the original sum, full amount of money you have taken as a loan. So the principal amount plus the interest is the liability straightforward. But the thing is that getting loan is very quick. Today you call the bank, start processing, within 2 or 3 or few days, you will get the funds. May not exactly you got the cash, but at least it is approved, and so you can get bit by bit from the bank. At least it comes in your account, so you can get it. On the other side, selling shares, inviting shareholders, capturing shareholders is really difficult. It's not an easy job. So in that case, it will take a lot of time, because you have to actually market your value, and you have to introduce the worth of your shares. You have to attract other corporate sector investors. You have to attract public. Multiple efforts you have to make for establishing your brand name, establishing your repute, establishing uh, your, or getting some share in the market. So all these efforts need much more time. So what same amount of money which you can take through loan, which may be available within a week or month, may be available through selling your shares over a year or more. So this is really a situation, tough situation. So usually people go for easy thing. So this is just like the NPV, virtually certain of standard forecast error, because it is not definitely you are getting the 100% exact value of NPV even. Okay, the good forecast for future revenues help minimize downside risk, right? Because this is actually helping you to identify. Let's suppose in this example, we try to understand this. Annual year benefits are mentioned, NPV is mentioned, after 5 years, for 5 years, MIRR year to break even is there. Right? Initially, you know that these years are failed, that it is not possible that you can get any break-even point. But then your break-even point starts from 4.9. It means they are more than 5 years. Therefore, it shows failed. And then it comes equal or below than 5 years. Then 4.8, 4. So it comes down and down. And ultimately, you'll find 2.93 is also possible if your cash stream is going to be increased. More the cash you are going to get back, so quickly your break-even point is coming. So secondly, your rate is going to be changed, right? So you can compare, you can observe how rate is going to change. It is going to rise, and it is the internal rate of return, it is the modified rate of return. So more returns you are getting out of your business, and automatically more returns mean NPV is going to rise. Okay, now these things are already clear into your mind. These downside risk situation, there are three possible options: forecast annual year and benefits, which is fixed 350, and secondly standard error forecast 10%, 5%, and 15%. And then standard error of in terms of multiply by this, and you will get this value, right? So this means this is actual investment, and this is the standard of that investment in terms of this percentage value. Okay, by using this percentage, you will use at 5%, at 10%, and 15%. What is the discount downside risk? Whenever you are applying these values, and you try to find out the probability, that how much probability exists at 10%, whenever your standard errors are 10%, that you will get this much return, 240, then 250, up to 250. It's not exactly same value, but the previous value. 250 include 240, 260 include 250 and 240. It means it is accumulated. So up to 260, how much? 51%. Up to 270. Right, more, sorry, it's not 50%, because percentage already mentioned, so it is less than 1%. So only it comes 1% to 270 and more, and then you are going to add more and more, up to 3 lakhs 7.6%, up to 390 87% chances, then for 40 99% chances, right? So these are the chances that you will get to your back, but mean less than and equal to this. On the other side, if you this standard error is going to change 5%, it will reduce, then you are becoming more strict situation. In a more strict situation, observe, you can easily observe that what is happening in the beginning of the time, near about 0% you are getting the possibility that you will get these annual benefits, or you will get you may have these returns. So but later, once you are going to move forward, this probability is going to rise, and at the end you will observe the 100% probability that you can get all these returns, right, at up to 420, 430, 450 and so on. But 15%, with 15%, then that is going to change, right? The values are going to change, and now 1.2% chances are there that you can have 240. So this means actually what is showing that deviation, it shows the 15%. So the range of deviation, let's suppose it shows the 5% deviation, then it is further 5% deviation, and this is further 5% deviation. 15% means 5 plus 5 plus 5, 15%, right? So 15% means this value is included and this value is included. In 5% only these values are playing vital role, and these values don't have any role. In 10%, some of these values, because out of this and this, out of this some value you are going to use along with this. So these 5% values are definitely always there, right? Because they lies in between, at the mid of the probability distribution. So there is high chances that your value lies within this range, right? So this range is more suitable. Mean to say, whenever you are going to make any decision, this range is more suitable. That in your business, mostly chances are there that you can earn 310 lakh to 410 lakh, right? So 1 lakh, within the 1 lakh range, you can earn your annual revenues, annual revenues, and then you can convert them into its net present value, and you can get how much exact net present value you are getting out of it, right? Okay, this meeting I don't know, because I didn't start recurrent meeting. I have started only simple meeting. If it is not going to be reconnected, then I will quickly share the next meeting link. So you may join that, right? Because only 5 to 7 minutes are there. After that, it will be closed. Okay, once you are going to convert these columns, these 3 columns, right? They are shown here. Then you can observe what is happening. This forecasting accuracy is going to be changed, right? Let's suppose if at 10%, 5%, and 15%, how this probability is going to be sharper. Usually what happens, if you are going to compare it with this 95 degree line, let's suppose it should be straight, but anyhow, right? You can draw a straight line. So actually this is showing that if you are coming closer, this means the probability that whatever amount you are getting is becoming equal, right? 50% chances, just like how much change is there, the same percentage change is there. So 10% to this much amount, then 20% to this much amount, 30% to this much amount, 40% to wherever crossing point is coming, exactly same probability is going to be happen, right? But if you are going to deviate from that, then what will happen? The probability is high, but the values, your net present values are low. If you are here in low region, then the probability is low, but your values are higher, right? Since it is going to start from this 0 point, so it means below this 0 you are not getting anything, because it is just like ghost. From this starting point onward, you have to be worried, right? So let's suppose if this point, just like this crossing should pass through, I think here. So this point nearby shows that this is the 50% chances, mean out of this this is the it shows nearby equality with respect to minus 1 lakh and plus 5 lakh. Mean it is the gap between both of the gap is equal to 6 lakh, right? And 1, 2, and 3, and this is the midpoint. 3 lakh from this side and 3 lakh from this side, right? Therefore, 50% probability that 50% of return you will get. So that kind of situation is mentioned here. So what is desirable? Simple. It should be, if it is closer to this line, then definitely forecasting is more easy. But if it is going to be deviated, you are always interested to have high returns with high probability. So you always desire that these high returns must have high probabilities, and this accumulated curve is showing that ultimately you are capable to have larger quantity if it is going to be more steeper and steeper, right? So the probability is going to rise for a given sum of value of money, right? But but if you are going to ask about how much probability that this you will earn 4 lakh, it is very low. If you are not going to use this cumulated value, let's suppose, just like I may mention to you what is the probability where we can use this one. Let's suppose this is the highest value you can use, and I'm just going to make it colored for more easy to understand. If you just compare with previous value, how much change happened? 82 to 87, 5% chances. 99.97 to 79, only 0.2% chances, right? And 95.68 to 92.3% chances. So actually, only 3% chances has increased or exists that you will earn 4 lakh 10,000 instead of 4 lakh, right? So this means for every value, if you are not going to use the accumulated table, then for every particular value you will get the probability, and it is very low. It is very low. Just like here, 250. What is the probability? Only 2.84%, 0%, only 0.2%. So this shows its actual value. Still, it has some kind of summation, but and for first value, it is exactly this probability which showing the exact value, which is not accumulated, right? So this means only 0.08%, 0%, 1.8, around 2%. It's very low. So for every particular value, exactly that value will get as a profit, as a return, is very low. But accumulated means we always interested to have accumulated returns. Mean, let's suppose my business has started and I have invested 25 lakh rupees. Now I'm going to recover 25 lakh rupees. In first year, I recover 10 lakh rupees. In second year, I recover 15 lakh rupees. So in within 2 years, I recover 15 lakh, 25 lakh rupees. So it is a cumulated value, right? So that is desirable because you need to recover in the same way. Okay, this is the last thing that you have to apply this scenario manager tool. You can do that through Excel sheet, but I'm not going to do that because I'm just going to stop here. This is the last slide and this is done. We are not going to do this Monte Carlo simulation, although it's very interesting and need to be done, but some other times maybe, or some other students maybe, because I have learned that I have to be a bit more faster if I want to move and add some these topics into your learning. But you will learn somewhere else, no worry. So I'm just going to rejoin, right? Because it's getting over, the time is getting over. So what we will discuss in the next phase, we will just discuss about the queries related to, even I'm showing the same slides. So whatever question you have related to this scenario analysis, or a different kind of risk return relationship, or how this risk is going to affect and how you need to combat this risk, all these things you can discuss in the next session, right? So if you have any kind of query, any kind of problem related to this part of discussion, you may note it down and you may ask, as well as you can ask generic question related to risk, how risk is going to affect the businesses, and it comes through which sources, just like the variation in interest rate is a source, variation in the prices of goods, specifically inputs,